the entire space, excluding stablecoins, rose from 15 billion to 35 billion just this year.
Think about it. You have a closing happening on Friday. You're selling 100 million. Well, you get it at 5 p.m., right? Well, that's too late to start placing that money overnight. So you have 100 million staying on your bank account over the weekend, not generating any yields. With a stable coin now, you can take those 100 million and swap it into a money market fund. What blockchain is doing, and I don't think that people really appreciate that, it's unlocking the power of innovation. Last time that I count, there were 600,000 people that could code in Solidity. Look at Apple and what they did with the App Store. When the App Store was launched, there were 500 applications. Last time I checked, there were 2 million applications, right?
Someone maybe come with an opposing view to you and say, hey, look, aren't we somewhat building or rebuilding TradFi just on-chain with new rails?
If a company like BlackRock is driving that kind of transformation, you can be sure it's going to happen. The future of finance is going to be very different than the one we see today.
Welcome to the Verified Podcast by Bitcoin Suisse, your backstage pass to the world of crypto. We host some of the biggest names in digital assets to cover the latest trends and share insights not only for your entertainment, but for the love of the industry. None of the discussed is financial advice, of course. It's all for informational and entertainment purposes only. So sit back, relax, and let's dive in.
All right, welcome back to Verified again. Today we have the pleasure to host Daniel Coheur. He's Global Head of Digital Assets and Fund Distribution at Apex Group. Prior to that, Daniel co-founded Tokenized and led it for 8 years before the strategic acquisition by Apex. And as of now at Apex, he's spearheading the integration of tokenization and fund distribution infrastructure across a large network of more than 14,000 fund managers. Today, we cover a hot topic, which is tokenization, how it evolves from pilot to production, how funds and securities are being somewhat retweaked, re-engineered for the blockchain era, and also what this means for more institutional investors. Welcome, Daniel. It's a pleasure to have you on the show.
Thank you very much for having me.
Hey, pleasure, Daniel. Also, hi from my side. So let's maybe zoom out a little bit, start with the journey and how it led to you being sort of a tokenization pioneer. I mean, you spent quite some years building telecom infrastructure, then also at Melio, you, for example, also led a company responsible for digital content distribution, and linking that also to tokenization. How would you say actually these prior experiences maybe align with tokenization? How did they prepare you for spearheading tokenization?
Well, it's quite interesting. You're making reference to this past experience. What I learned from that, let me tell you, I worked for a company that was a clearinghouse for mobile operators. So what they had in common is that they're both transactional business. And what I learned from this is that, so Cineverse, this company that I joined and I spent 10 years working at, was sold to Carlyle for 1.8 billion. And we were charging 0.0000001 cents per call that people were making in roaming, right? But still, we were sold for 1.8 billion. Why? Because it's a volume business. So we built, the platform of Tokenized, not to charge innovation as a premium, but to build something that will be based on transaction. The whole business model of Tokenized and what we built is reflecting the fact that this has to be a scale business, right? Then even charging 0.00001 cents per transaction will make it a very attractive business. And that's what we've been building. This engine is truly a transactional platform that enables with very little upfront costs to be blockchain ready and start bringing your assets on chain. Because if you charge for innovation, you create a barrier of entry that only few companies can afford. And we, from the beginning, we say that's not the way forward. That's why we build this engine. That's why we build talking to all those asset servicers. Because for us, you need to work with the people that are managing, servicing those assets, because this is where the scale will be coming. One product will not get you the benefit of decentralization. It will bring you the benefit of digitalization. If you want to get the benefit of decentralization, it has to come with scale. And that's why we are looking at everything we do with this perspective of scale. How do we achieve scale? Asset servicers, custodian. That's really the focus of Token and what we've been doing with Apex and others for the last couple of years.
Okay. I think it's also somewhat linked to Chapman's paradox, where low cost basically induces demand to some degree. And it's a cool view to kind of try to make it via the sheer quantity. As you know, there's this saying, and we also saw that during the dot-com bubble, where people tend to overestimate things in the short term and underestimate them in the long term. I feel we are somewhere in between where, I mean, tokenization, also other topics in crypto, like were hyped a lot, such as GameFi, for instance, but took many years now to get traction. I think tokenization is now at the point where it gains like genuine traction, like sustainable momentum. The growth in the last couple of months, especially since we have more supportive legislation and regulatory frameworks, has been tremendous. I guess you check the numbers every now and then. We saw like private credit rising a lot, tokenized private credit, commodities, including gold, obviously, also tokenized equities. I think it's crazy. The entire space, excluding stablecoins, I think rose from 15 billion to 35 billion just this year. In your view, is this just the beginning? Like, what total addressable markets are we looking at? What are your projections for the upcoming years in terms of acceleration?
Yeah, well, anything we can project is going to be wrong anyway. But I definitely see this use case of treasury management being the one that will unlock this potential. It's pretty clear that every corporation, every bank, every entity has cash on its balance sheet, right? And today the process of creating yield for that cash is very cumbersome, is very inefficient. So now we have a very lean, regulated, by the way, process to create yields, while obviously not being an expert in banking or finance, right? Now, of course, a caveat here is that regulation like MiCA and the Genius Act are not supporting yield-bearing stablecoin. So there we will see some form maybe of arbitrage coming up from emerging markets like Abu Dhabi, for example, where you can have yield-bearing stablecoin, or Bermuda, where you can have yield-bearing stablecoin. And by the way, the Bermuda currency is pegged to the dollar, right? So if you have a Bermudan yield-bearing,
it's a good workaround, yeah.
It's a good workaround, right? But clearly, it's two things, right? This regulation will create opportunity for people to start creating their own stablecoin. Why would you obviously have Circle or Ripple stablecoin that are not yield-bearing when you can have yield-bearing ones you owned? So that certainly put a limit to the one that can have their own stablecoin. That's why at Apex we will be creating this service to help company creating their own stablecoin. We will provide regulatory assistance, if not regulatory umbrella. We'll provide, of course, tokenization capability. We'll be providing proof of reserve. We'll be providing a middle office to invest the underlying assets. So it will be an end-to-end service, which is, by the way, what we already do for our client today. In that case, the underlying assets is treasury or liquid instruments, but you have a lot of assets, of clients' assets that indeed have underlying assets similar to what you have in a stable coin. So for us, it's just rebranding the service to stable coin, but that's what we do today. So we see a lot of potential there of company launching their own stable coin, or indeed people that do not have the size or appetite that will simply swipe those stable coin into yield-bearing instruments. That's why in the last month, we've seen tremendous appetite from asset managers to launch money market funds. So it will be very easy indeed to swipe this whatever position you have in USDC, USD, or any stablecoin for that matter into such a yield-bearing instrument. So that will so think about the position that exists in cash today in the markets. I don't have a figure in mind, but this is huge. So I always say that finance is very efficient. If there's a way to create yield, it will. And there was already a lot of inefficiencies in the market today, a lot of new company, especially if you think about what we do, right? Private equity. So think about it. You have a closing. So a fund is basically selling an asset, right? And the closing is happening on Friday. And Friday night, you receive the proceed of that closing. You're selling 100 million. Well, you get it at 5 p.m., right? Well, that's too late to start placing that money overnight. So you have 100 million staying on your bank account, on site overnight, for over the weekends, not generating any yields. So with a stable coin now, and with those, tokenized instrument, you can take those 100 million and swap that into a money market fund. So people may think, yeah, but it's only 3 days. Well, I remember my good old days at Clearstream that those overnight treasury placement was the number one revenue of Clearstream. So this is not trivial. So if you look at your individual position, that's not a lot. But if you look at large company and the amount of cash that they're handling, that's not trivial at all.
Maybe a follow-up to the stablecoin part. I think what happens around Genius is very interesting. Also, Mika, I guess, like I'm interested in your view, like having this prohibition both in Mika and Genius on like not being able to distribute yield. Do you think that it stems from the banking lobby to some degree, where there is some fear of deposit flight, maybe? I mean, we also saw like JP Morgan now launching a deposit token. Obviously, what stablecoins do not bring is like the magic source of fractional reserve banking, right? So you do not really have this under-collateralized angle in stablecoins. I'm wondering, like, what is the medium outlook here? I mean, you said it already, like there is probably people trying to figure out like some workarounds. But I'm also interested in how is the banking industry like really facing this new technology being stablecoins?
Well, I don't want to be sound too political here. Obviously, there is with a high level of certainty a lot of lobbying with regards to how regulation is evolving, right? We talk about very huge financial institutions that maybe are not ready to start embracing this technology and want to push back. Regulatory development to avoid being themselves impacted by those technology that they don't really control or master, right? But clearly the benefits are there. It's unavoidable. It's hard to say now how they perceive that. You have forward-thinking company that are already embracing it. Société Générale and the work that they've been doing with Forge is a good example of that. So you can see that you have TradFi company, quite conventional company that are stepping in and they have issued a stable coin under Mika. So I think this is, in my view, this is just reflecting a certain level of inertia that exists in those large companies. It's not that they're not willing. Maybe they are skeptic. Of course, they are cautious. Of course, and you know that there is always the most important person in a company, which is not the CEO, as everybody knows, but the compliance officer, that is certainly pushing back because this is his role. But this is not reflecting the lack of appetite. This is just reflecting a process. When you have companies of 40, 50,000 people, you don't bring new technology in-house overnight. So what we see as being slow, again, in TradFi, I think this is rather efficient. And we'll see in a couple of months, there is a lot of large banks. There are consortiums that are being created to create stable coins. So all those, and by the way, there was a lot of trials and pilots. We were part of a pilot, already 5 years ago between Crédit Agricole and BNP Paribas with the Banque of France to demonstrate how we can issue a CBDC. So it's not like they've not been involved or doing things about it. It's simply that this is a process. Once this process has been established, and that's the good news about that, they have the scale. That's why we can be critical on TradFi and they're not fast enough. True, but they have the scale. So the moment that indeed they start embracing the technology and they will deploy that across all the users, all the clients, then you will see that it will become mainstream.
So very interesting. So just one tiny question on top of this, like that to some degree does imply that Tether and Circle will lose market share, right? To other maybe more established traditional financial players.
Well, it's clear, but I'm pretty convinced that they do have strategy to hedge that risk. They will certainly also be open to white labeling the technology and leverage the expertise that they have to enable third parties to start issuing. So I'm not concerned about their future. Tether is already the most profitable company in the world per head count. So great job that they did, right? But that also demonstrates that if you don't distribute yield, well, you can really make a lot of profit, right? So that's a good indication for a company that, well, maybe they should be their own stable coin. But again, just an observation, not a criticism. So I think that they've been doing an amazing job there.
Also, circling back was very interesting what you said. I mean, that it takes time for tokenization to really penetrate the market, or if you have now big banking institutions with thousands of employees, that is not something you can really implement overnight. So I'm curious, maybe also from your point of view, what does it actually mean in practical terms, tokenization, right? How do you actually bring things on chain? How do you bring real world assets or physical assets, or also traditional asset class vehicles on chain in terms of tokenization? So what are the steps really? And maybe also in that regard, what is then sort of maybe a roadblock that some of these institutional players really face when embracing tokenization?
Absolutely. Well, I think, give me 1 second, because I think that my battery is running low. Sorry, well, here we go. So yes, it's true that for a lot of people, tokenization is still a black box, right? And that's why I'm really keen to stop making reference to tokenization. Tokenization is a technical feature that you bring to existing system to upgrade basically your capability. It's not creating a different type of instruments. It doesn't bring in you more right or different rights. It's just representing it on an infrastructure that have more capability. That's it, right? So the compliance is embedded, and therefore the token can start, or the security or whatever you represent can start existing into a decentralized world while not compromising on compliance, right? That's why Token has been developing those API to enable company to create representation of those assets on chain in a compliant way, leveraging the framework. Of course, in the association, we have 14 other tokenization platforms. Anyone is free to use, another solution than Tokeny if they want, if they have a better commercial arrangement or better SLA, whatever it can be. So this is an open source standard. It's true that the work we've been doing and the learning that we've been doing is essential, because people have a tendency to undermine the complexity of technology. Yes, it's true that if you take an ERC20 to create a representation of your assets, and that ERC20 goes into an application that is a closed application, and the token doesn't go anywhere, and you whitelist wallet, that's it. It's easy to do, right? And to be honest, you can do that for $20. That's more or less what it's going to cost you, right? If you want to have a token that will live in a broader ecosystem and that can be used for secondary, for distribution, for DeFi, you need something more sophisticated. And that's really the purpose of the RC3643 and the work that Tokeny has been doing. So, and this is also linked with the strategy to create scale. Don't focus on tokenization. Tokenization is now a commodity. Doesn't mean that it's simple to do. Again, let's not confuse. It's very complex to do, but there are solutions to address this complexity, right? So focus on something else now. Focus on the value that you will create for your clients, because clients are not interested to get a token in reality. They're interested in the value it can create. Will it indeed expand my distribution capability? Can I collateralize it? Can I use it in a DeFi protocol? So how do we do that, right? That's why in Tokeny now we have these labs that are working with the Apex client to showcase, how we can indeed deliver more value. And secondary is really on the top of our priority list and distribution, because this is really what the market wants. So yes, I guess this is answering your question.
Yeah, very, very interesting to hear. And maybe now, what would you say if someone looks at traditional financial rails, TradFi rails? As you said already, then there's this tendency to undermine the complexity of systems. Now would someone maybe come with an opposing view to you and say, hey, look, aren't we somewhat building or rebuilding TradFi just on chain with new rails? Is there really an efficiency gain to be made with tokenization, or is it maybe just more intermediaries and not even as cost efficient eventually? What would your counter argument be? Because you're obviously then at the very center of building tokenization for TradFi rails.
Well, you don't need to be a rocket scientist to understand that if an asset goes from one silo to the other, and therefore none of those silos can be trusted, and you need intermediaries to make sure that you're not, keeping a copy of that assets, or that the payment is properly going through, right? It's not difficult to understand that if you remove the intermediary, it's going to be more efficient, and cheaper, right? Again, you can apply that to any vertical, any use case, right? And if you put scale on the top of that, so not one transaction, but millions of transactions, that gives you an idea of the size. That is just the beginning. If people do not understand that it will be cheaper and faster, then obviously they, I don't know what they have to do, but do something different. But that's the start. But that's certainly not the end. What people do not understand is that here we are just creating the representation of the assets, which bring its own benefits. Now, what is the future of finance? Look at Apple and what they did with the App Store, right? So when the App Store was launched, there was 500 applications. Now there are, well, last time I checked, there were 2 million applications, right? What blockchain is doing, and I don't think that people really appreciate that, it's unlocking the power of innovation. If in the past, innovation was siloed into the platform you were using. If you wanted to have something different, you needed to make a request. The company had to prioritize that request, need to look if there was a business case for that request, blah, 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 blah. And then maybe you have that feature 2 years after, right? Now, if the data is represented on chain, right, there's no dependency on that platform anymore. That service or that change request or that feature you need can be brought by a DApps. So we see great potential coming from those DApps. So for those who are not familiar what DApps are, so this is the acronym for decentralized apps. And decentralized app, what they do is that they read the blockchain and they execute smart contract. So if, for example, you have a DApp that could be executing a subscription and a redemption. You use a vault, you can use solution like Enzyme, for example, where you place your money into that vault and automatically, the vault will execute a subscription into the underlying asset that has been defined in the vault, right? And that happened without connecting to any back office. Everything, all the transactional bits is happening between the smart contract and the blockchain, right? So last time that I count, there were 600,000 people that could code in Solidity. So you can think the number of those DApps that we are going to see coming into the market, and that obviously we as an asset servicers will need to check, we need to control, we need to make sure that if indeed those DApps are accessing our client data, we need to make sure that they are properly vetted, there's no security risk. Coming back to the analogy of Apple, what Apple does when they release an app, the first thing that they check is the integrity of the app. Well, they also check that there is no outside of the app purchase, because the model is to take 40% commission on all those transactions. That's a different discussion. But more importantly, they check the integrity of the app. So we see very much the role of an asset servicer evolving to ensure that indeed, if an application is accessing the client data at the demand of the client, that this application is legit and does not create or represent any risk whatsoever for the client data, right? But you will see there will be thousands of applications, 100,000 of applications that will be doing very different things. So, a couple of years ago, it was impossible for us, despite the fact that we are born with the internet, to think what the TikTok would be. So what will be TikTok of finance? What are those applications that will create yields and deliver more value? So everything will be decentralized. So the roles of company like us will definitely change, and we will have to adapt. But I think that the future of finance is going to be very different than the one we see today.
I like the answer, so I'm glad that I asked it maybe in a pushy denial or non-believer point of view, how you see tokenization, and you gave a perfect pitch, I think.
Again, I predict that in a year from now, nobody will talk about tokenization anymore, because it's a feature that will be brought to those platforms, to the solution, and that's it, right? It's similar to wallet. Nobody will talk about wallet. It's hard to say how that will evolve. Will solution like account abstraction be leading the way? Account abstraction, unable to decorrelate the wallet from the ownership. So you can basically identify yourself with a Web 2, so your Google sign-in, for example. And then there's a wallet, because this is what you use indeed to sign transaction. But the wallet is managed by a paymaster. And that brings the benefit of not having to worry on which network the token is being deployed. Because that's, at the end, if we talk about adoption, people are not talking too often about that. But still, if you want to buy a token, you need to know on what chain this token has been deployed. You need to have the gas of the chain. So this is a bit of complexity there. Account abstraction, you just log to your Google account. You don't care where the token has been deployed. You don't care about what crypto you need to pay the gas. It will be done by the paymaster. So I strongly believe that this will come much faster than what we think, especially with companies like Google or Microsoft that are now starting to invest massively into this. They are the key to who you are. So for them, being the paymaster to power and sign those transactions seems like a logical next step to reduce the complexity and the friction with interacting with the technology as an end user.
I fully sign up with this, or resonate with this as well, because I mean, we saw that with other verticals or industries where the technology then eventually moved into the background. And I mean, we also use an iPhone and don't really know how it works, for instance. I guess you outlined a lot of like really like strong benefits in terms of tokenization, including like you can make illiquid assets liquid to some degree. You have this notion of cross-border settlement, the sheer pace. What I'm keen to know from you, do you think, like, we know the financial industry or financial area ever since is dealing, especially now that we are more digital, more globalized, ever since is dealing with this jurisdictional fragmentation and patchwork where you have different regulatory frameworks. How does this translate into tokenization? Do you think this will soften up to some degree? Do you think maybe emerging tech like CKIDs or something like that, where the KYC part isn't that big of a problem anymore, will soften this problem up? Or will we forever deal with this jurisdictional fragmentation and like there's no way out of this?
Well, okay, so if we talk about regulation exists for two purposes. First is to avoid money laundering, and the other one is to protect investors. So I think that the example of KYC is a very good one. This is still by far the biggest pain of the industry. So I anticipate that we will have digital solution for KYC. Now, the problem with KYC is not a problem of technology, it's a problem of responsibility. So if for example, I do a KYC and you have a company that is supposed to do the KYC for you and is relying on the KYC that I've been doing, and then it happens to be a fraud, who bears the responsibility? Me that have done the KYC or you that have accepted my KYC? So I think that we need to have regulatory support here to start implementing this notion of mutual recognition. So we need to align of what are the KYC rules, because every bank has different KYC rules, taxonomy. So why don't we, one for good, align on that? One, we align on the process, and that start with heavily regulated entities. The one that indeed are, you will be sure that if, Apex has done a KYC, that you can trust that KYC, right? If Boni's done a KYC, you can trust that KYC. So if we start building that mutual recognition to a certain point where the risk is going down to a certain, to the level where it can be ruled by a contract, then we're good. So I remain very positive that, this is going to be addressed. Now, on the other side about cross regulation, again, the problem here is about protecting investors. Having said that, there is already mechanism in place that allow an asset to be going from one country to the other. We have, for example, American depository receipts that enables those assets to be traded, outside of their jurisdiction by simply creating a new legal entity for allowing that assets to be encapsulated. So clearly, blockchain is going to accelerate that. And there's a need and a will, from investors for that. You want to buy SpaceX, right? How do you do that today? Well, you get to your bank. Your bank is a broker-dealer. The broker-dealer is the broker-dealer in the connection in the US. So again, a lot of inefficiency driven by the fact that the market is segmented and the technology is siloed. So what Xstocks has been doing, starting to distribute, and they have now, I think, more than 2 billion in capitalization, in transaction, reflect that there is an appetite. Now, let's not confuse, and that's very important, retail from institutional. Because a lot of people that are talking about those use cases are people that are retail investors thinking like retail investors. So you want to buy a Tesla stock, you want to buy, but what do those family office want? Are they interested in buying this? Well, maybe to a certain level, but they are more interesting to have access to funds, BlackRock, Blackstone, Stepstone, etc., because those companies typically, want to hedge their risk. So, and there, I think that the existing regulation already allow that. What you need to do, though, is to go through a process that we call passporting. So if you have an asset being issued in US, for example, you need to register it in Europe, make sure that you follow the rules to protect investors. So those rules are not too difficult to follow in reality, right? You just need to have a mechanism to ensure that those rules have been followed. And that's really what the RC 3643 is about. Have you registered your prospectus? Yes or no? Is this asset available for retail? Yes or no? You don't want to let an asset that is not available for retail because there is not enough information that has been made available to the investor to assess the level of risk it represents to access that asset, right? So those rules are there for good reasons. And I think it's important that they remain there. Of course, tokenization increased transferability, access to those assets. But with the RC3643, we bring the level of comfort to regulator that the existing rules that are there and will remain will still be enforced. But of course, cross-border transaction will accelerate because what tokenization means, and I mentioned that in the beginning of this podcast, is that the rules now are basically in the token and are following the token from one network to the other, right? In the past, you just had an asset and you had to go back to the origination, so to the asset servicer that was originating this asset to check, is this asset available for distribution in this country? Well, I have no clue. And that would probably take 2 weeks for that confirmation to happen. Now, as the rules are embedded in the token, you instantly know that this token can be distributed in that country. So yes, it will accelerate, the transactions and the availability of those assets and adoption, of course.
Very interesting. Maybe this segues quite well because you talked about like both the retail and the institutional part. I'm keen to see like, what do you think? Obviously, we are very early in the entire tokenization leg, but what are the next big trends in terms of tokenization that you anticipate? Maybe there's a lot of chatter around on-chain structured products, maybe even an on-chain IPO, on-chain ETFs. What do you think is the next big trend or the next big area that we see like a substantial growth, maybe both from the retail but also from the institutional side?
Well, from the retail side, you can already see what's happening, as I mentioned, with X stock. So you really disintermediate, access to retail investment. I think from what we are at Apex, what we see is this. We call it retailization or democratization. This is not exactly true because in reality, what it is, it's about having those assets that were more institutional, I would say limited per se, that will now become available to family offices, to high net worth individuals. BlackRock typically, and that's the middle use case. In a way, this is about fragmentation. It's about fractionalization. It's normally you need 20 million to invest into a BlackRock, and then what people were doing is in Germany, for example, Moonfair has been doing that. You create an SPV or a feeder, and the feeder invests the 20 million, and then you split that among 2,000 people, right? So I think that this, I would say, democratization, retailization is going to happen because there is a demand from family offices to have access to those assets. But even the large family office, they cannot put 20 million into those assets, right? So, but then again, tokenization is not facilitating that because you could do that to feeders, but it came with a cost. So what's going to happen is that because tokenization and digitalization will reduce the costs of all those processes, now asset managers will have the ability to start doing that themselves and not relying on third-party feeder for doing that. Let me give you a good example. If today you do a KYC for a company that invests 10 million or a KYC for a company that invests 100K, this is the same KYC costs. So the only way that you can reduce the minimum tickets, so have more investors, is by streamlining your KYC operation to reduce your internal costs. Because the GP is not willing to pay that cost, because if he does, it's going to reduce his profitability. If he reduces his profitability, he's going to reduce the yield that he's going to pay you, and he's going to reduce his carry interest. So he's not going to do that, right? So if you reduce all those operational costs, then you allow to reduce the minimum entry tickets into those investments. And that's really the big thing that we see from our world, is that democratization to take place. And I'm not saying this. Larry Fink from BlackRock said that, already more than a year ago. He insisted on that again in his last presentation to his investors. So I think that if a company like BlackRock is driving that kind of transformation, you can be sure it's going to happen.
Well, speaking of that transformation, also big institutional players, what do you think in your view, if maybe even had to take a bet on it, what is the major market that will really push through this mass adoption of tokenization and assets on chain? Is it funds, private credit? I mean, we spoke about yield products, stablecoins on chain, or is it even for most retailers the easy access, maybe something like real estate, art, or collectibles on chain?
I think that we need to be realistic with the type of underlying assets, right? Because if you want to invest in alts, in illiquid assets, you need to have a mechanism also to create some liquidity, because you're not going to invest into an asset that you can only redeem in 10 years from now or 5-6 years. Institution will do, Because if you have a pension fund and your objective is to create value for you when you retire in 20 years, you don't care about duration. But at the retail investors, let's say, even if you make a lot of money tomorrow, right, will you still be projecting yourself in a 10 years investment? Well, if you have no kids, certainly not, right? So I think that you still need to create the liquidity behind those assets to make it happen, which is really what blockchain is permitting, right? But here again, more precisely, it's not creating liquidity. What it does is reducing the illiquidity costs. In private market, you don't have liquidity. That's a false perception, because you don't have the understanding of the value of the assets, so you cannot have a liquid market. But you do have a very high illiquidity cost. So when you want to sell, you have to sell with a sharp discount. So if you use that sharp discount, that requires the asset managers to provide more frequent mark, because otherwise you have to trade on sentiment, which is very complicated. So, but if GP are driving this, providing solution like what we do at Apex, for example, we have a solution that enables GP to provide liquidity window. So you set the price, and every quarter you can trade at that price. And GP are keeping part of the money they collected in cash to meet those investors that wants to sell. But if you have more participants, you reduce your relative cost. The GP does not have to provide that liquidity, so it doesn't have to keep the cash, so he can reinvest that cash to create more yields to the fund. So you start with a more liquid market, and that liquidity will unlock, more adoption as well. So it's a virtuous circle behind that. So definitely in private market, I see huge potential of growth that will be driven by this middle market, high net worth individual, etc. We see a trend around that, for example, with more what they call interval funds or evergreen funds. So funds that obviously do not have an end life. So you obviously need some liquid solution in order to provide enough guarantee to your investors that they can get out of that fund. So we see more and more that trends happening in the GP world. So yes, that's probably where we see most growth. But again, I think that every industry, being private credit or anything, has pain points. And as I mentioned earlier, now that we have this engine and then we have regulatory clarity, I think that more and more what you will see is those DApps or those tech-driven GP that will come and address those pain points. So it may come unnoticed because, again, that will happen behind the scene. What you want to focus on is more liquidity, more yields, but the technology behind that will definitely be blockchain.
I guess the sheer maybe new opportunities on chain will stimulate liquidity eventually, for sure. Maybe moving a couple years forward, in your view, I think we touched briefly on it already, but in your view, like, how does the end game of this digital financial transition look like? I mean, there are some cool visions, like maybe at some point in the next couple of years, you are able to just manage your entire portfolio, including treasuries, out of your smartphone wallet. Maybe you buy an ice cream around the corner and swap some of your, I don't know, Argentinian treasuries into ice cream. In your view, or what would you like this future to look like?
Well, you can already see, a lot of disintermediation taking place, right? Role of bank are changing. So I think that self-custody will probably become the rule. So you will not have your assets sitting somewhere else. It will be sitting in your wallet. So I think that indeed self-custody will be the rule. So people with direct access to their assets, those assets will be available instantly. So you can indeed think of investing into a high yield product. So think about, now what you do, you have your money at the end of the day that you're spending, and you typically leave that on your cash account, right? Now you can invest everything in a money market fund that is bringing you 3-4%, better than a livret A in France, for example, and you just switch, or even have your credit card debiting directly from your money market fund, right? So the notion of cash always on is a game changer. So cash will always be producing interest. That's definitely something that is going to be a game changer. There will be no cash anymore that will be stayed somewhere, because the reality is cash is always producing interest. but you don't get the benefit of that. That's how banks make money, right? So cash will always be producing interest. You will be more in control. You have access to a lot of different investment opportunity. The risk, of course, there is to make sure that you only have access to what is appropriate in terms of risk for you. So there again, we need to make sure that investors are protected, and regulation therefore is super important. If you could invest all your money into crypto, I'm sure that people would do that, right? Is this sound? Is it a good thing? I don't know, right? I don't know. So we will have. So that's something for debate. Obviously, I don't have the answer to that. Not everyone is capable of accepting such a level of risk, or capable of taking such a risk. But definitely, again, as I said earlier, the future of finance is going to be very different.
Yeah, much agreed. And it's also interesting to hear your insights. I mean, centering them around self-custody and also what the first, let's say, institutional railways are, but also maybe a retail investor has other priorities surrounding tokenization and the next steps of digitalization.
Agree. Totally agree.
Yeah, very cool. Hey, thanks a lot for your time. I think on behalf of Bitcoin Suisse and our audience, we truly appreciate it. I think what stood out to me is like somewhat the importance of standards for the entire tokenization arc. What you touched on in terms of democratization, access is really something that is truly unique for tokenization and helps improve the entire financial landscape in my view. And then also the arc that capital formation and liquidity is an essential flywheel, but it's in the early stages and is improving. I think for our listeners, check the show notes, please. We will provide some links to Apex Tokeny, also the standards that Daniel mentioned. Subscribe us, rate us, review, please. Again, thank you, Daniel. It was a true pleasure to discuss all of these very important aspects. And yeah, until next time.
Thank you very much. And on a concluding note, we didn't even touch on AI. So and that's probably the subject for next
for another hour.
Is
Part
indeed
two.
how AI and tokenization will change the world of finance. Thank you very much for having me. It was a pleasure, and look forward to continuing this journey with Bitcoin Suisse and your team.